part of the reason for having a program here is trying to bring up some of these issues. But we have an unlimited marital deduction that applies if you're a citizen, your spouses are citizens,
Yeah.
that you can give your property to your spouse, and there's no estate or gift tax consequence
Right.
from making that outright gift.
The concept is the surviving spouse, there'll be an estate tax at her death
Yes.
on the combined estate of the couple. That's just not possible for registered domestic partner and same-sex married couples right now.
Okay. Now, how about, there is another rule that we were talking about. It has to do with disclaimers. And this is getting a little esoteric for you folks, maybe that you're not so familiar with the estate and gift tax rules, but it's an important part of estate planning. And so maybe you can talk about that for just a few minutes.
It's an important point to keep in mind. Estate planners very often are used to using draft forms that have been developed in the context of husbands and wives. It is not very easy to take those forms and revamp them for same-sex couples who look like husbands and wives, act like husbands and wives, but aren't considered that at the federal level. One example of this is the disclaimer problem. A lot of people plan their marital deduction planning by leaving everything to the spouse and allowing the spouse to disclaim, and the amount that she or he disclaims will then go into something we call a bypass trust or a credit shelter trust. It's a trust in which the surviving spouse has a life interest. Under the disclaimer, and her disclaimer will not be treated as a taxable transfer under Section 2518 of the Internal Revenue Code. But anybody else who disclaims and the disclaimed amount goes into a trust in which the disclaimant has an interest will be a taxable event. It will be treated as a taxable gift. So the standard post-mortem estate planning that you can do with husbands and wives, you just can't do it with same-sex couples. You could, but you're going to get taxed on it. It would be a bad plan.
Yeah.
So a lot of people don't realize that. They think that they can mirror at the federal level the same kinds of plans that husbands and wives have.
Now, this is especially important now in a sense, because the type of planning that so many of us have been doing for the last several years, because of the uncertainty.
Yeah, post-mortem estate planning is best in these days of uncertainty, but it's just not available to same-sex couples.
So the point that I'm trying to get across to you folks is right now we've got these $5 million exemptions. Those are going to be going away unless Congress does something. Now, hopefully they will.
We said that once before.
Yeah, but they're going to be keeping us in suspense probably. I mean, it just seems the way that it works these days. And so the point is, though, for married couples, we sort of can create some flexibility for ourselves by having these disclaimer type of arrangements. In other words, the spouse can decide whether to take the property that's bequeathed to them or not.
Or instead to just take a life estate.
Yeah,
that's
to just
the effect
take a life,
of the disclaimer.
they can put it into this trust and they still have the use of the property as far as they can get income from it and so on, but it will not be included in their estate.
Right.
So this is sort of the traditional type of estate planning that we were talking about in a sense. But again, because of the uncertainty related to how much exemption we were going to have and so forth, these were very common types of arrangements to have for spouses. It just doesn't work for registered domestic partners or for same-sex married couples.
Not so long as DOMA is on the books.
Okay. All right, well, here's an interesting one now. So married couples, we have community property, a very critical part of this planning and so forth. Estate planning is how we take title to property.
Right.
And for example, taking it as community property right now, if one of the spouses passes away, you hold the property as community property. You get what I call a fresh start basis. Some people call it a stepped up basis, but it's not necessarily.
Sometimes it steps down.
Yeah. But basically, the basis for the property, in other words, the cost you use for it for gain and loss on Schedule D if you sell it, is the fair market value on the date of death.
Right. And I call it a double step up in basis for community property because if you owned it as tenants in common instead of community property, you'd only get a step up or step down as to 50%
Right.
of the basis, and not as to the 100% of the property. It's one of those quirky rules that came about when Congress was trying to equalize common law property states and community property states. It's much criticized, but it's been with us since 1948, and I think it'll stay around a little bit longer. So it is a benefit if you own appreciated property as community property. It's an income tax benefit.
Right. And it's huge. In California, you know, I mean, the advantage of a California couple compared to a New York couple.
Right.
That you get this adjustment for both shares. Now, by the way, this does not apply for joint tenancy.
Right.
As I
Tenancy in
understand.
common or joint tenancy. It's only
boom.
available for community property.
So just be aware, although you can make a community property agreement, still holds, you know, you sort of.
Well, I
but
still
it's not-
think
it's kind of
it's
messy.
valuable for same-sex couples to hold property as community property. They don't get the double step up at the federal level because that's controlled by statute, and the statute uses the word spouse. So
Okay.
long as DOMA is on the books, you don't get it. But you do get it in California for state income tax purposes. And California income tax are high enough to
make
warrant,
it worthwhile.
make it worth your while to do that.
So
Yes.
the federal maximum rate right now is 35%. California is about 10%.
Right.
So it's a little less than a third. I mean, it's still pretty important. But the point is that because the statute refers to spouses
At the federal level.
at the federal level, that you don't get the double step up for same-sex couples, again, the registered domestic
Right,
partners or
right,
married couples.
Right.
All right. Any other recommendations that you make for planners who's working with a same-sex married couple or a registered domestic partner?
Sure. One thing I like to tell people is, remember, DOMA is not going to be with us forever. We have one federal district court that has ruled that it's unconstitutional. That could be upheld on appeal. We've got a case in the Ninth Circuit. We've got a case going in the Second Circuit. So we're getting a number of serious judicial challenges to the law. And of course, President Obama said that he supports the repeal of DOMA. So there will be a day, and it may even be in our lifetime, that, that DOMA goes away. So when you're drafting wills, you're drafting for the future. You don't want to assume that DOMA is always going to be there. If you're representing same-sex married couples and there ought to be some marital deduction planning in that estate, then I think you want to do something that I call contingent marital deduction planning. It can be tricky, but think it through. All you need to do is you can create a bypass trust, but make it qualify as a Q-tip. And then they can elect as a Q-tip and get the marital deduction. But if you don't plan that in advance, if you don't draft it right in advance, it won't qualify because you have to have a mandatory payout of income to the surviving spouse for it to qualify as a Q-tip, and you can't have anyone else with an interest in the trust during the surviving spouse's life. Not all bypass trusts are drafted that way, so you have to be careful and draft it.
Okay, so let's explain Q-tip for a minute because a lot of people don't know what it is.
Okay.
So it's a qualified terminable interest property is what it's short for. It's not for something that you put in, you know, or you're not supposed to. Anyway, so
Well,
what it does is...
You start with a general rule that in order to qualify for the marital deduction, the gift cannot be a terminable interest. You can't give a life estate to your spouse. The idea is for it to be taxed at her death, and if you give her only a life estate, she doesn't own anything at death. But then somebody got the bright idea that, well, what if we make it a terminable interest property, but make it qualified in such a way that she'll be taxed on all the income during her life, and they elect to have it be taxed at her death as though she owned it outright. And so you have these qualified terminable interest property trusts, and so long as you dot the I's and cross the T's, it will qualify for the marital deduction. So it's a way to make a qualified marital deduction with a terminable interest in property, and there's only one way to do it, through the Q-tip.
So basically what you're suggesting is when you're putting together an estate plan for a same-sex couple, it's a good idea to have a lot of if-thens in there.
Yes.
So if the Defense of Marriage Act is declared unconstitutional or otherwise doesn't apply, then we'll have this qualified terminable interest property type trust that will be there, and then otherwise then we'll have other alternative arrangements.
And some people have suggested naming a trust protector. If you name a trust protector in the document, give the trust protector specific authority to amend any trust that is needed to be amended for marital deduction planning for estate tax purposes.
So a trust protector is like somebody that you're sort of giving the right to step in your shoes and to put in things that you'd put in if you
yes.
could. Okay, so it's good to put this contingency sort of stuff and to be thinking about all these. So this estate planning for same-sex couples, as you folks may be gathering, is actually quite a complex
It is.
process.
It is. And every state is different because they have different state property laws and different recognition of relationship laws. And you need to also remember that your clients move from state to state, or they may own property in other states.
Mm-hmm.
And some states have estate taxes that are separate from the federal estate tax, and they have their own rules.
Oh, absolutely.
It's a big chess game.
Oh, yes, it is. I don't think we have a whole lot of time left, but for about a minute, could you talk a little bit about irrevocable life insurance trusts?
Yes, one way to avoid being taxed on life insurance is to have someone other than the insured own it. Now, in California, of course, you've already got an opportunity. If you've paid premiums with community property and the insured dies, only 50% of the value of the life insurance proceeds will go into the estate because it's deemed to be community. But a lot of people want to keep 100% of it out, and so they create something called an ILIT, an irrevocable life insurance trust. And they usually name the uninsured spouse, the surviving spouse, will have a life estate in that interest. Well, remember, this is a problem for husbands and wives too. If you pay those premiums with community property, and then the insured dies, that $1 million that may be sitting in the ILIT could create a Section 2036 problem. The surviving spouse will be deemed to have made a transfer, her 50% of the community premiums, and retained a life estate. And that can be bad on the death of the second spouse.
Okay, so be careful on also then paying attention related to planning with an irrevocable life insurance trust. Pat, we covered some really complex issues here. I thank you so much for being my guest and joining me today. Folks, maybe you know a same-sex couple or whatever. We will post this at financialinsiderweekly.com, and so that people will get access to this information. And we hope that you found it valuable. And we'll see you next time on Financial Insider Weekly.